Employee stock purchase plans represent another exciting and unique form of equity compensation. In this video, I'm going to talk through what are they, what are the different plan types, what are the tax implications you need to know. So let's begin with what are they? They essentially allow you to purchase shares of your company stock through payroll deduction. And this is no different as if you were contributing to a retirement account like a 401k or 403b, where you're designating a certain percentage of your paycheck to put into the employee stock purchase plan. And companies want to motivate or incentivize you to purchase their stock. And they do this generally by offering a discount on the purchase price. And the discount's going to range from employer to employer. So you want to check out your plan specifics, but with tax qualified ESPPs, they allow discounts anywhere from 0 to 15%. The other note with ESPPs are every time you get paid, you don't immediately buy your company stock. Your contributions to the plan are pooled in some type of fund, and then the cash from that fund is used to buy the company stock on a designated purchase date, which is typically the last day of the offering period. So now let's talk about what are the primary plan types. The first one is your qualified ESPP plan. When I say qualified, it's tax qualified according to the Internal Revenue Code. And most employee stock purchase plans fall under this tax qualified category. And as a result, the IRS benefits you with preferential tax treatment. And because the IRS allows for the preferential tax treatment, they're actually going to cap the amount one can purchase of stock within a tax qualified plan to $25,000 in one single year. The next type of plan would be your non-qualified ESPP. And again, these are far less common compared to the tax qualified plans, but they do afford more flexibility as far as plan design. An example of this would be with a non-qualified ESPP, you could be offered a higher discount compared to what the IRS would permit under a tax qualified plan. So in the same vein as taxes, let's talk a little bit about what are the tax implications you need to be mindful of. And we'll focus here on the tax qualified plans because, again, they're a lot more common compared to the non-qualified plans. So the first thing to notate is when you contribute to the ESPP, it's typically done on an after-tax basis. So you're not receiving an upfront deduction. This may be different to how you contribute to your 401k if you're making that on a pre-tax basis, but contributions to ESPPs are usually done on an after-tax basis. And with ESPPs, you're actually not paying taxes until you sell the stock. So taxes are triggered upon a stock sale. And the nature of the tax that you pay will ultimately depend on whether a qualifying disposition period was met. So a qualifying disposition period says you waited 2 years from the grant date and 1 year from the purchase date before you sold the stock. So it's and, not or. You need to wait at least 2 years from the grant date and 1 year from the purchase date before you sell the stock. And if you met that criteria, they benefit you with part of your transaction being treated with the preferential capital gain tax rates. But I say part of the transaction because there also is an ordinary income tax component as well. And your ordinary income tax with meeting the qualified disposition would be on the lesser of the discount granted at the time of you purchasing the stock or the calculated capital gain. So your ordinary income tax will be the lesser of the discount or the calculated capital gain. So this amount that you pay in ordinary income taxes is important because you need to add that to your original purchase price or cost basis to determine the next type of tax, which would be your capital gain tax. So your capital gain tax will be the price you actually sell the stock minus your adjusted cost basis. And your adjusted cost basis is going to be what you bought the stock for originally plus the amount that you paid in ordinary income taxes. And since it's a qualifying disposition period, you'll be benefited with the long-term preferential tax rates. But not all stock sales meet the qualifying disposition criteria. So a non-qualifying disposition period would mean that you'd sold the stock either less than 2 years from the grant date or less than 1 year from the purchase date. You'll see how I did or rather than and, because if you fail one of these requirements, then it's considered a non-qualifying disposition. So if it's a non-qualifying disposition with your stock sale, then you do have ordinary income taxes as well. And that's going to be based on the stock price on the actual purchase date, subtracted by the discounted purchase price. So the ordinary income taxes for a disqualifying disposition would be the stock price on your actual purchase date minus the discounted purchase price. And then again, we want to be mindful of what you paid in ordinary income taxes, because we have to add that to what your purchase price was originally, your original cost basis, to determine the capital gain tax. So the capital gain tax for a non-qualifying disposition would be your sale price, so what you sold the stock for, minus your adjusted cost basis, which again, the adjusted cost basis would be what you purchased the stock for originally, plus the ordinary income taxes that you paid. And the determination of whether that's short-term or long-term will vary whether you held the stock for longer than 1 year after you purchased it, or you sold it less than 1 year. So if you sold it less than 1 year after you purchased it, you'd be subject to the short-term rates. If you held the stock for greater than 1 year, you'd be subject to the more preferential long-term capital gain rates. So hopefully this was helpful. I did write an article that provides much more detail and examples on this topic, and thank you very much.